And then earnings season is starting next week because we are now in July. The first half is over. And so we're going to start to see the banks will begin, and then we'll move forward into, there in a couple of weeks, we'll have hundreds of reports every single week. And it gets to be a crazy time as an investor just to try to keep track of everything that's going on. But from a really big high level position, right now, earnings expectations are low. If I had a dime for every article I read about how corporate profits are going to be coming in below expectations, and we're going to hit a profit recession, and there's so many people that believe that we just have to have a really bad earnings season, either this quarter or just generally this year. But that's not what's happening, at least not yet. And we haven't seen any clear evidence of this, although we've heard a lot of people shouting warnings. There just isn't that evidence. We're still seeing companies earning profits and growing those profits. And so that puts us in a place where you have to think as an investor, if everybody has one perspective and then reality comes through and earnings reports are released and it is different than that perspective, what is the market going to do? And so in this case, as we enter earnings recession, we're in a bull market, right? The trend is higher. We have negative expectations. People are worried about what's going to happen. If things come in negative, that fits with what people already expected, right? So we shouldn't see much adjustment happening. But if these earnings reports come in stronger than expected, then people have to adjust. They're already too bearish. They have too much cash on the sidelines. Now they have another reason that they need to put that cash to work to keep up that whole fear of missing out. And so I do think that as some of these earnings reports come in, if they're stronger than expected, that could be another catalyst to drive another leg higher for the market. Now, remember, Matt likes to talk about me as a professional investor, and it has been my career for 25 years. A lot of people think of professional investors as working very, very methodically and very unemotional when it comes to markets, and you should be. That's absolutely how a professional investor should behave. However, think about this for a second. Every professional investor is a human being with a job, with performance that they need to keep up. And if I can tell you from my time at the hedge fund, if you are always judged on your last quarter, how did you do? What have you done for me lately? That is the question that your investors ask and that your bosses ask. And so if you enter this third quarter, we have earnings reports, the market moves higher. And if you as a professional investor aren't keeping up with the market, your job is on the line. Your head is on the block. You might lose your job just because your fund or your account that you're managing isn't as high as the rest of the market. So this fear of missing out is not just for individual investors, it's for professional investors too, possibly more so for professional investors because it's a career risk to not keep up with the market. So if the market continues to move higher, if we have a positive earnings season, if we move across this wall of worry, we could see another strong leg higher for this market. Now, one thing to remember, I know Jim has talked a lot about, some market bubbles and some areas of froth and some areas where stocks are trading too high. Tesla and Nvidia come to mind as stocks that are really just too high compared to where they should be trading and what the profits that they're earning. Well, yes. That may represent the fact that we've got a bubble, or at least a bubble in certain stocks. And it may be crazy that these stocks are trading at a certain level, but you don't get crazy without a process of building that crazy. You don't get a bubble without a period of inflating that bubble. And so we may be in this season right now where that bubble is inflating, where fear of missing out is driving more capital into the market, where people are saying, okay, I finally feel a little bit more comfortable. I want to invest that money. Is that right long term? Maybe not. There are risks that we're looking at long term. But for this quarter, for this period, for the trend that we're in right now, all of this points to higher prices, at least in the short term, for these stocks. So I would say, you have to think very carefully every time you buy a new position. What is my time frame? What am I expecting? Am I buying a position because I'm worried about the long-term future and I'm buying a defensive position? That's fine, but just know that it may take a few quarters for this defensive position to play out. Are you buying a position that's aggressive? That's fine. Just know that we may really well for a month or 2 months or a quarter or 2 quarters, but have your finger on that exit button, because at some point when this turns, then you'll want to lock in your profits and look to a more defensive posture. So right now we are definitely in a bull market. We do have, I think the risks are skewed to the upside. We have some negative perspective heading into earnings season, which could wind up making people have to adjust their positions and become more bullish. And all of that doesn't preclude the risks that we're seeing in the market, but it does kind of put that question into timing. And you have to think short term and long term, how are things going to play out? So Matt, does that sort of make sense, and maybe square that circle in terms of the risks that we have, but also the bull market that we're in right now?
Yeah, it's important. Like all these cycles, like you can look at a day or a week or a month or the half of the year. What we're seeing is what you're saying is true. And what we're seeing is like, just look at, now I'm going to micro down into yesterday, into today. Yesterday was a kind of like a smack in the face to the market. Like, hey, we might get some more rate hikes. Things aren't great. And at one point, the Dow was down over 500 points. And it didn't look good. A few months ago, if you have a day like that, it would lead to maybe a week or two of negativity and pullback. I don't know what's going to happen in the next week because I don't have a crystal ball, but today we rebounded pretty well in certain sectors, not the whole market. Like the Dow isn't back, making up its losses, I don't think, unless something's changed in the last few minutes. But there are buyers coming out, and it goes to what Zach's saying. If we're in a bull market, if there is FOMO, we have, I believe, flipped into a buy the dips mentality. It could change next week, next month, whenever, but you get a buy the dips mentality. That is just more bullishness. There's buyers coming out of the woodwork that are saying, oh, this is the one time when I think I could get in. Because what they do is they see the Dow down 500 points, and then they're like, I haven't deployed capital. I'm going to go deploy capital today because that one stock that I want is just a tiny bit cheaper. I'm going to go buy it. And then you just start filling up order books like that. And that's how the market works. So, and it can be irrational. We're here on the Rickards Uncensored call. We know nothing with the economy looks great. Nothing with politics in America looks great. Nothing. But one of the things, if you want to make excuses for why the market's going up, maybe the de-dollarization theme and the fact that inflation's coming down the road, maybe all those things are adding up, and it's starting to say you got more risk in cash than you do in being in the market. So there's all these factors at play as to like what's happening. But the truth is, we have a bull market happening. We are seeing some buy the dips days, and month over month, I think it's getting stronger because we're cutting off some of those down weeks into down days and stuff like that. Zach, you had something that you were sharing just then?
Yeah, just kind of going along with what you were saying, I'll share it again. This is a chart of the S&P 500. And I did want to mention, just as you were talking about how yesterday was a down day, and it was, but yesterday, this is that this little bar that you see where my cursor is right here. That was yesterday's pullback. And if you look at the big picture, that pullback is actually very small compared to where we're at for this week, for this month, and then for this year. It's very small compared to these overall trends. And so I think that is one of the biggest points of advice I can give anyone who is trading, to not take a single day or a single week and try to make a trend out of it. Because if you look at yesterday's pullback, it's smaller than the gap higher that we had a week ago. And it's still within this overall bull trend. So just be careful not to read too much into any one of those day-to-day moves. Even when the Dow is down 500 points, 500 points isn't what it used to be. If you think about the percentage rise or decline.
Yeah.
It's funny. I used to tell the story about during the financial crisis, you'd come into the office and the Dow was down 100 points day after day after day after day after day. And that was terrible. But now when the Dow is down 100 points, it's, 0 point what percent. It's a very small perspective. So if you've been trading for a long time, it's sometimes easy to get those numbers anchored and then to not realize that, okay, well, a 500 point drop in the context of the overall bull market that we're in right now may not be quite as bad as it seems in the moment.
Yeah. Yeah. Really, a bad day is over 1,000 point drop. And then a really bad day is 2,000. You don't get too many 2,000 nowadays, but yeah, it's we're or in
Hopefully
that
not.
new world. Yeah. I know some people ask questions about this. I didn't see any, but I'll just say it right now too, because like I say some of the stuff I'm doing in my personal portfolio and allocation. I will say, right, 6 months ago or whatever it was, maybe 9 months ago, I was way more bearish, pulling back. But in the last 6 months and then 3 months or whatever, I've almost flipped. I went from 75, 90% cash, and now I'm flipped. And it wasn't all in one day. It was just over time. I'm now 75% in the market. So again, take it for what it's worth. I'm here as a publisher, but as a reader of our content and seeing what's happening in the market. And again, those aren't crazy. I'm not going nutso on what I'm buying, but that's just my cash to stocks allocation. And it has flipped because I think what we're starting to see is some reality that like we're heading into a bull market. We've got the FOMO that Zach's talking about. Institutionals are coming in. There might, Zach, you said it earlier, soft landing. There might be the case for that, or, the case for the soft landing, the case for inflation, whatever it is. Those two things make stocks go up. So you add that to the fact that like there's money still sloshing around. There's reason for this stuff.